Hello, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And as you know, in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. The aim of these case study episodes is to show you how it all works out in real life by sharing a client story, if you like, or a client that I've been working with many years. And I haven't done a case study episode for a while. I will continue to do them. It's just that I've got a whole bunch of listener questions to get through. So that's been my focus. But this will be the last case study episode for 2024. So it's been an interesting exercise. And in fact, forcing myself to go back over clients and kind of review their journey. It's been quite a insightful and sort of rewarding process. It takes a bit of time, but it's been good to do. Okay, so the client that I want to talk about today is that we started working with them in mid-2009. So a little over about 15 and a half years, I guess, when you think about it. The female was in her late 30s and the male was in his early 40s. And just for context, they were both earning around about $150,000 back in 2009, so relatively high incomes, of course. And in terms of investment assets, when we started working together, they had about $500,000. So they owned their home, which was worth 1.3, didn't have any debt. But with respect to investment assets, they had an investment property that was worth about $540,000 with $240,000 of debt, so about $110,000 of equity in that investment property. Had about $112,000 of cash, and then super was about $260,000, $185,000, and then $75,000 to the other person. I can't remember if it's a husband or wife in terms of balances, but around about, or just under $500,000 in terms of net worth. So if we fast forward 15 and a half years, where are they today? Well, their net assets are now worth $3.9 million. So about an 8-fold increase over the last 15 years. I think if I look back on that journey, they'd be pretty happy with those results. Their home is now worth $3.7 million, but they've got $256,000 of debt. So they actually upgraded their house a few years ago and took on a little bit more debt. I should say net investment assets, obviously, of 3.9 exclude the home, right? So they've obviously put a bit of cash flow and equity and so forth into their primary place of residence, but I'm not looking at that in terms of the wealth impact. But of course, there is a pretty significant wealth impact. In terms of property portfolio outside super, they own 4 properties worth about $5.4 million with $2.9 million of debt. So we've got about $2.5 million of equity in a property portfolio. Regarding super, they've got one property in super. The value is $765,000 with $332,000 of debt. So about $430,000 of equity in that property in super, together with about $890,000 of managed investment shares, cash, those sorts of things. So total super is 1.35. So that's increased from about 250 to 1.35 over the last 15 and a half years. They've got a little bit of shares, about 30 grand. They've got some investments for kids, although I think they were about 250,000. I think they were funded from some inheritances they received. So really, over the last 15 and a half years, we've got, in terms of cash and property portfolio, they started off with about $220,000 of equity. They've now got $2.5 million. In terms of super, about $250,000 to $1.35 million. So both those asset classes have performed really well, and we'll get into the bit of the sort of nitty gritty, if you like. The clients are now 53 and 59, and they'll probably work for another sort of 5-ish years, I would expect, but they've built a significant asset base. Let's talk about their property portfolio and just run through the properties, if you like. They purchased a house in Northcote in 2009 for $607,000, and that's actually owned in a discretionary trust because at the time the client was going to become self-employed, wanted some asset protection, and we were going to be able to have the flexibility to soak up any negative cash flow, negative gearing by distributing into that family trust. Don't think it ever eventuated her becoming self-employed. And if it did, it wasn't for an extended period of time. It makes it kind of interesting, right? When you make decisions around property ownership structure, we've got to realize that things can change in the long run, and we really should factor that in. And we do factor in, of course, when we're thinking or talking to clients. But sometimes I find clients can be quite short-term focused when thinking about ownership structures. not really thinking, well, will things change? Should we balance it all out? Anyway, the next property we purchased, it must not have worked out because the next property we purchased was another house in Fitzroy North for $800,000 in 2002. So that's 3 years after the first house. And that's owned in personal name. So as I said, between '09 and 12, obviously their plans changed. Next purchase was an apartment inside their self-managed super fund for just under $590,000, just a little over that. And then in 2017, purchased another apartment in personal names for about $820,000. And the final investment property acquisition was made in 2018. That was a house in Paran for just under $1.3 million. So that's 5 properties purchased between 2009 and 2018. So a circa sort of 10-year period, if you like. Quite deliberate. They used a buyer's agent to assist them with the selection of all 5 properties, which is important. And they didn't rush into the market because sometimes I see articles or clients posting or talking about their journey and they've bought 5 properties over the last 2 years. That's fine, but you don't need to implement it that quickly. And I think a more deliberate approach and considered approach often yields better outcomes. In terms of their super, as I said, they bought a apartment in 2012 for $590,000, and at the time, in fact, it wasn't until 2013 we took over the management of any remaining funds. I don't think they had a huge balance of remaining funds, about 150,000, I think, looking back. And obviously super is now 890,000. So that portion of the funds other than property, if you like. So it's really grown from 150 to 830. Now there's some expenses and so forth. So I've had to sort of round it off. But essentially it looks like, now as far as I can tell, because there can be transfers between accounts and a transfer might not be a contribution, but I've netted it all off. It looks like over the last 11 years, so since 2013, they've contributed into super around 300,000 net, and the investment returns have been about 280,000. Now, I mention that just because I've got some feedback. I've received feedback from these case study episodes that it's important to sort of weigh up what is returns, what are contributions. But essentially, it looks like the returns are even. It's about 50-50 in terms of contributions and investment returns over a relatively short period of time. Let's face it, super is a long-term investment. So they've done really well and they've made some really astute decisions, I would like to say, with our guidance, of course. So as you know, in these case study episodes, I like to sort of paint the picture, which I've done. This is where we started, this is where we are today, and this is what's happened in between. Let's look at the key learnings and insights. Let's stand back and say, okay, what can you and I, learn from this experience? Well, I think the first one is that my thesis is that with astute asset selection, typically by using a professional reputable buyer's agent, you should be able to outperform the median house price growth. And when you look over the last 40 years, median house price growth has been high sixes, around about 7%, sort of that mark. If you look over the last 20 years, it's been a little bit lower than that, 5.5% circa again. So it depends on, so what time period you want to look at. But at the end of the day, the market will do what the market will do. All you can do is either pick up that market return, which is really the premise of index investing, or try and beat the market. And, as I said, if we apply a set of fundamentals that I've spoken about a lot in this podcast, we should be able to beat the median. Well, looking at the houses, because looking back at the houses they bought in 2009 and 2012, it's probably important or useful to look at those 2 purchases because there's another house they purchased in 2018, but really we've only owned that for 6 years and it's been a pretty tumultuous 6 years in Melbourne specifically. But anyway, when you look at those first 2 purchases, the compounding capital growth rate has exceeded the median growth rate by 1 to 1.2% for those 2 properties, which they've owned for more than a decade. And I think that's really important, right? We want a full cycle in there. And even I would say the last 10 years in Melbourne hasn't been so fantastic. So when I talk about, and I should say, by the way, the house they purchased in 2018, it has also exceeded the median, but the median hasn't really done very well. in Melbourne over that 5 years, there's been a couple of good years and a few bad ones and a couple that have just moved sideways. So I guess when we're looking for the evidence, can we beat the median? And I could find millions of different examples, of course, in my client base. But from this client's perspective, yes, it's possible. And I think I would say that I've spoken about this previously on this podcast, that my gut feeling is that investment grade assets are intrinsically undervalued. So that is the gap between the cost for an investment grade house and a non-investment grade house isn't as wide as it has been historically. And so I think if I prepare this analysis or look at this analysis in another 10 years, I think the evidence will be really compelling. Anyway, it's a good example of if we buy well, we'll do better than the general market. The next lesson is diversification, right? Because they've got 3 houses and 2 apartments. If they had to put all their money into apartments, they wouldn't even be in the position where they are today. And apartments will have their day. I've spoken about investment grade apartments in this podcast many times, particularly with respect to Melbourne and particularly how they're intrinsically undervalued. The technical value of apartments clearly exceeds their market value at the moment, even just on a land value basis quite often. But the point is, apartments will have their day. And we've seen that in cycles as well, where there are periods of time where apartments perform better than houses. And of course, we've just been through a period of time, last 10 years in Melbourne, where houses have done a lot better than apartments. So the whole point of diversification is that you want a finger in each pie. So regardless of the cycle and what's happening in markets, you're at a whole portfolio level, you're seeing some growth, at least in some of your assets. And so that's a great lesson for people that are constructing a property portfolio. One of the things that they could have done is add some geographical diversification. So all their assets are in Melbourne. It's quite common that people are keen to have all their assets in their domicile state, but of course these days it's not necessary. And if you're open to owning assets interstate, like I do, I can assure you there's no real difference between owning an asset interstate versus owning an asset in the state that you live in. The next kind of key learning is they bought a property inside Super 12 years ago, the apartment inside Super. They've been making some repayments towards reducing the debt on that property. The LVR, and of course the property's increased in value a little bit. The LVR is now 40%, so really conservative LVR, but also most importantly, they've been building some diversification inside their self-managed super fund as well. As I said, they've almost got $900,000 of share investments. So they've got themselves into a position where they'll never be forced to sell, or at least it'd be very, very unlikely they'll be forced to sell the apartment. Whereas quite often I see many situations where a client gets into retirement, they've got a lot of property inside super, and they have to go and sell one of those properties in order to fund pension payments because obviously properties are liquid and doesn't throw off too much income. But with these clients and with some careful planning, they're in a situation where they'll easily be able to afford to hang on to that apartment for another 10 to 20 years and ride this sort of flat cycle out into a growth cycle, enjoy that full growth cycle, and then potentially exit that investment and not pay any capital gains tax. And they've only been able to do that, obviously, because, we've been engaged to invest some of that surplus cash flow in the market. As I said, it's done pretty well for them looking over the last 11 or so years. The other observation is that they're pretty good at managing cash flow. They're quite diligent, in fact, at managing cash flow, which is not to say that they don't spend a lot of money. So I gave you the incomes at the beginning. As I said, they were both earning around 150,000 each, so about 300,000. Their family income has, in more recent years, been around about 500,000. So significant income, right? But their expenses are high too. The living expenses, they estimate, excluding any repayments against loans, so the investment property stuff, is about 230,000. They've had private school fees, a whole bunch of expenses, travel, those sorts of things. So I would say, yes, certainly they've got a high income, but I would say that they've found a perfect balance, if you like, between investing and saving for the future and building your nest egg versus kind of enjoying today. Making sure, well, you're going to work hard, earn a decent amount of income. You want to enjoy the journey, if you like. So, building wealth is not really a destination. It's a bit of a journey, and you've got to enjoy that journey, and you've got to spend a bit of money today within your means, and then also make sure you're carving off a little bit for the future. And I think their scenario and their case study is a perfect example of that. And probably the thing they've done really well. And the key to doing that really well is just being really deliberate and conscious around how you're allocating cash flow and having that balance between, okay, if I want to go on a European holiday, no dramas, but what do I need to do between now and then to also make sure that my financial position is moving forward? If I have a look at all their properties in terms of locality and type and those sorts of things, they're all going to work. If I produce this case study episode in another 10 years, for example, and certainly in 15 years, I think it will confirm, how well property does over very long periods of time. As I said, the property they purchased back in '09, so about 15 odd years ago, has performed really well. And it shows that, the longer you hold a property, you will eventually see that performance. So I thought it was a really good case study to share with you today. And I think there's a few insights there in terms of property and building a property portfolio. You don't have to do it overnight, even if you acquire a bunch of assets within your means over the next 10 years. That's completely fine. You want a deliberate and well thought out acquisition process. You want to build in some diversification in terms of asset type. So a few apartments, a few houses if you're buying multiple assets. Maybe even think about geographical diversification because that would really help too. Think very carefully about ownership structures because life changes, which is what these clients have experienced, and making sure you've got a really good balance between spending for today and saving for tomorrow. I believe that you should be able to do both, and it's important to prioritize doing both. We could all be hit by a bus tomorrow. You may as well enjoy your time on this earth. It could be limited. Gee, that sounds really negative. I don't mean it to sound negative, of course, but that's the whole point of having the context of a financial strategy is that you know how much you need to squirrel away for tomorrow and then how much you've got left over to enjoy for today. Okay, let's get into some listener questions. As I said, I've got a lot to get through. So the first question is from Paul, and Paul writes, I really love the podcast and cannot wait for the new episode every week. I've been listening for many years now. I've tried unsuccessfully to become a client of yours twice now, and I thought it was funny that I heard another listener saying the same thing. I still pass on your details to people that I think would benefit from your immense knowledge and experience, as I know you're one of the best in the country in my view. Paul, thanks so much for the feedback. And I just wanted to read that out and sort of address that. Of course, as a business, it'd be great to help everyone, but we've really got to think about the sustainability of the business and, really owning a niche, if you like, and also creating a business that's going to attract really great people that want to do interesting work. And that means that we can't help everyone. And that's really unfortunate, but it's also the reason why I put so much time into the podcast and the blogs. The business is now at a size where, arguably I don't necessarily need to be doing so much of this sort of stuff anymore, but I really love it. I enjoy answering people's questions. So please share the stuff that I put together for anyone that's listening to this. And I do apologize if you do contact Pro Solution and we decide there's just not enough scope to justify our fees, because that's ultimately what it comes down to, is we've got to be sure that if we're going to take on new clients, and for example, we're going to charge that client $5,000 a year for the next 10 years, so 50 grand, we want to be in a situation where we're absolutely certain that we can deliver substantially more value than $50,000, but also that the client really needs our advice. They couldn't do it themselves or find a way to do it themselves. And if we can tick those two boxes, we'll take a client on. If we can't, we just don't think it's in their best interest to pay us a fee if we can't, hand on heart, say, that we're going to deliver more value. So, but that's distinct from sharing this blog and podcast, of course. So, if you do think someone's going to benefit from it, I'd still appreciate sharing. And what I try to do in the answers is sort of elaborate or give you an insight into the way that I'd be thinking about a particular problem or question. And certainly, hopefully, that helps people sort of figure it out themselves as well if we can't work with them. But thanks, Paul. Great feedback. And sorry that we couldn't help on this occasion. Okay, so let's get into Paul's question. Paul's question is, I've recently changed super funds from CBUS to UniSuper. I currently have 123,000 and I'm 42 years old. Just as a side note, of course, CBUS has been in the papers recently for all the wrong reasons. UniSuper is the fund that I think is the most transparent and best. So good move, Paul. Well done. Paul goes on to write, my goal is to maximize returns up until retirement and my risk profile is high. I've heard you mention many times that you don't know enough information about the listeners because they haven't provided enough information. So I'm going to give you all my information. My current investment property values 6.5 million with 3 million odd thousand dollars of debt and $150,000 of savings. By the way, Paul, I just see why we probably concluded we couldn't help you, because with $3 million of debt, I don't know your income, but with $3 million of debt, you're pretty highly leveraged. We're probably assumed that you wouldn't have necessarily a lot of surplus investable cash flow, and that reduces our scope. Anyway, that's the sidebar. I'll go back to Paul's question. He continues to write, I am in the process of setting up life and TPD and income protection as part of the defence for my portfolio, and I'd like to pay them from superannuation for a cash flow purpose. In brackets, even though I understand paying from personal cash flow would be more beneficial from a tax perspective. Yes, that's true for income protection insurance, but not for life and TPD. You would have life and TPD inside super. That's actually most tax effective. You can put income protection inside super as well with a split policy, what's called a split policy. So you still get the same coverage as a policy outside super with all the bells and whistles, but the part of the policy is owned inside super and part of it is personal. But better to have the level of insurance you need, even if you're sacrificing a little bit in regards to tax effectiveness. Okay, so Paul goes on to say most advisors are advising that I use Hub24 as they have outperformed my previous super funds by 3 to 4% per annum. Okay, here's a red flag. Paul goes on to write, they've all given me compounded return differentials from previous super funds compared to Hub24 for the next 25 years, and obviously there's hundreds of thousands of dollars difference. Their funds are actively managed, not passive at all. Doing some research into both fees of actively managed funds compared to passively managed that have substantially lower fees, I find a lot of information pointing to active fund managers underperforming the index by substantial amounts, and being in passive funds for the long term is more advantageous. My gut feel now is to keep the funds in a passive fund, as no one knows where returns will be over the next few years, but there's certain that the fees in actively managed funds will be higher. Okay, great question, Paul. A couple of points. Hub24 is not a super fund, of course, it's just a platform. So Hub24 hasn't done anything. It's a little bit like saying CommSec has outperformed. Well, it's not CommSec, it's or whatever your share trading account is. It's what shares you've invested in. I'm not picking on your terminology there, Paul, but just making sure that sort of people understand it's not really anything about Hub24. It's just a platform like NetWealth and so forth. We use Macquarie and NetWealth. It really comes down to the investments. I think that if a financial advisor tells you we're going to outperform by 3 to 4%, that's kind of a red flag. I don't really talk about investment returns because I can't control investment returns. I don't know what they're going to be. So I don't want to set an expectation that our returns are going to be better than alternatives. What I'm going to say is that our approach is evidence-based, and if you apply the same approach, or if you had have applied the same approach historically, it would have produced the best outcome. But the reality is, who knows what returns will be? We just can't control it. And when someone says, I'm going to outperform UniSuper or CBUS by 3 to 4%, to my mind, that's a red flag because historically their returns haven't been too bad. Whether they're going to be great in the future, I'm not sure. And I think will indexing and evidence-based strategy outperform by 3 to 4%? They could, but I would never say it, because I think the probability of it is low. Normally when you look at it depends on which active versus passive, but normally when you look at, say, a value overlay index versus a traditional market cap index, the outperformance can be 1 to 2%, sometimes 3%. So it's a bit of a red flag, firstly. Secondly, Paul, you're completely right. There's called the SPIVA report, SPIVA. If you just Google that SPIVA report, it'll take you to S&P Dow Jones website, and they produce data globally, and you can access this. which compares all active managed funds to the index, and it will show you that the vast majority underperform. So fees are for certain, returns are uncertain. You're always going to pay those high fees. So it doesn't make sense to me. I wouldn't switch. I'd stay with UniSuper. In fact, you've got to then factor in the fact that you're going to have to pay these people a fee as well. And that's going to be a drag on performance as well. And if you're highly geared like you are, you got 3 million of debt. I don't know your income, but I'm going to assume you're highly geared. Then really you don't probably have enough scope. If you're just going to pay these people look after your super, and once you add in those fees, their fees, it's probably going to be uneconomical for you. And that's why it's really important. I think that's a really good point, because you've got to think about what is the scope I'm getting advice for. Now, these people, I'm not going to cast aspersions on them, but I would say that they should have just looked at your situation and go, well, this person's just better off in an industry fund because they don't have to pay our fees. And the industry funds have done pretty well. But clearly they're trying to sell a service and a product here as opposed to give advice. Okay, next question is from Kieran, and Kieran's written quite a long email really about land tax. And I must have said in previous podcasts that it's really something to think about and forecast. Anyway, that's a long email, and I think he's corrected some of his calculations. And sorry, Kieran, I couldn't really get to the bottom of your question, but I think I understand it. I think what Kieran's asking is how do you consider land tax really with respect to whether to invest in a particular state? So geographical location, property type, budget, those sorts of things. So Kieran, maybe if I speak to that might answer your question. Land tax is really insidious because you typically don't pay it when you first invest. And if you do, the expense isn't that material, except for Victoria, because obviously they've increased or reduced the tax-free threshold. So all investors are paying land tax now. But of course, if we go and buy a high land value property, that land tax is going to get worse and worse each year. And after you've owned the property for 30 or 40 years, you'll be in a situation where the land tax is a considerable portion of the property's income, and really is a massive drag on income. Having said that, by the way, you're sitting on millions of dollars of equity, right? So no one's going to feel too sorry for you because you've got this massive land tax bill, because you've also built a substantial amount of wealth too. So there's obviously two sides to the coin, if you like. In our financial model, when we draft plans, we do have a projection of land tax. Now, projecting tax consequences is kind of difficult, even if you think about the income tax rates, because the impact of inflation will mean that your average tax rate climbs beyond a reasonable level. Because obviously, as inflation improves our income, because obviously our income rises each year, hopefully. I mean, as a general macroeconomic observation, incomes rise. And then you're going to get that bracket creep because you're going to then be in the highest marginal tax rate relatively quickly, solely because of inflation, even if your real income hasn't really changed. So what we have to do in these circumstances is kind of index the marginal rates, if you like. So when the highest marginal tax rate will kick in, and that's been sort of the trend, certainly over the last 20, 30 years, where governments start adjusting, maybe not as soon as they should, but start adjusting the tax rates to make sure that you don't get that bracket creep. Having said that, if you look at, there's a few charts on the internet that demonstrate that Australia has significant bracket creep, and the average tax rate in Australia is way too high. Now, how does this all work then with land tax? Because really, Victoria hasn't changed its tax-free threshold for, I think, about 15 years. And in fact, now they've actually wound it back by having this COVID levy land tax amount that sort of comes on top, which means that your tax-free threshold's $25,000 or something like that. So it's really difficult, I guess what I'm saying, to forecast these things. You can't really do it with any sense of confidence because, tax can change, situations can change. But what you want to do is, as you build a portfolio, the key thing to really look at is how the land tax might change if you add an additional property in that jurisdiction, and do that comparison. I think that's the most important comparison to make. because land tax will be what it will be. All you really need to do is when you go and buy your second investment or third investment property, you just want to measure which is the best outcome. So, for example, I think I remember mentioning in a podcast, we had a client, they already had a investment property in Queensland, and we were deciding we're going to buy another one. Do we want to buy it in Queensland or should we buy it in Melbourne? And when I did the calc, the land tax was going to be a lot more in Queensland because we've already got a property there. We've already used the tax-free threshold for that property. And that's where I think it's most important. The other element is really just understand the cash flow impact, but there's nothing you can do about that, right? And the point is that if you end up in 20 or 30 years' time sitting on this massive amount of equity, but the property's killing you in terms of cash flow, well, it's not ideal, but you might just have to sell that property. You'll pay 23.5% maximum of the gains. You'll keep more than 75% then of the capital gains. And it's a pretty good outcome. We would like to maybe pay no tax, but we're probably going to have to pay some tax along the way. So, Kieran, I don't know if that answers your question because I don't really, no offense, understand the question that you're asking, but hopefully that commentary around land tax gives you an idea. And particularly when we're thinking about land tax and ownership structures, that's important, building a property portfolio and just being mindful of land tax outcomes. Because the biggest mistake I see is we've got too many properties in one state, or we've got too many properties in entities, and that's been structured incorrectly. They're the key mistakes that I see with respect to land tax. The rest of the situations are just circumstantial and as a result of property doing well, which is, well, it is what it is, right? But thanks for your question, Kieran, and thanks everyone for submitting your questions. I hope you've enjoyed today's case study episode, getting back to one of these case studies. Between now and really the new year, sort of mid-June, I'm going to record all Q&A sessions between now and then, and hopefully I'm going to get through a bunch of these questions that I've got. That's my goal. And then hopefully when we get back next year, in 2025, I'm greeted with a whole bunch of new questions. So if you have any questions or feedback, you can send them to me at questions@investopoly.com.au. And until tomorrow, bye for now.